Hello, friends. Thank you so much for joining me today. This morning, we received the largest daily volume of new economic data this year, including GDP for the first quarter, the PC inflation index, and much more. In this video, I'll walk you through all of this data and help you figure out what it all means. And yes, I must say that there are very good reasons for concern, since the latest data will clearly cause alarm to both the US Federal Reserve and Donald Trump, which means that the conflict between them may intensify. All of this signals that even more volatility is ahead of us. In addition to these economic facts, which we received, and forecasts for the future, by the way, were also revised downwards. So, with all of the above in mind, let's move on to this news. Let's start with the GDP for the first quarter. The US economy shrank by 0.3% year-on-year in the first quarter of this year. And this is the first reduction from 2022. The main reason for the decline was a sharp increase in imports by 51%, as companies were probably in a hurry to get goods in advance, expecting an increase in tariffs. Unfortunately, many media outlets do not talk about this table, which explains what actually happened to the US GDP. In the first quarter of 2025 year, there are a couple of interesting points here, except for imports, which of course affected the value of GDP. First of all, it is government spending, which also put downward pressure on GDP. The fact is that the growth rate of government spending has slowed down. This means that the public sector has not supported the economy as much as it did before. And the second point, which also surprised me, and which few people talked about, is private investment in the economy. They grew by 21.9%. This is a very strong growth. This should have pulled GDP up, but it did not help due to a sharp increase in imports and weak government interventions. The probability of a recession against this background has soared to a new peak, 74%. This happened after the GDP data for the first quarter of 2025 turned out to be worse than expected. The forecast, or more precisely, the expectations, were that the US GDP would grow by as much as 0.3%. In fact, it turned out to be a decrease of 0.3%. This is a very big discrepancy between fact and expectations. That's why this is a real nightmare for the Federal Reserve. But the situation for the federal system is actually getting worse. After all, the PCE price index for personal consumption expenditures showed an increase to 3.7%. This exceeded the expectation of 3.1% and is much higher than last month's figure of 2.6%. So there is clearly an upward trend here. When the PCE indicator increases, it means that the prices of goods and services are also rising, which may indicate an increase in inflation. If inflation grows faster than the economy, it can lead to economic instability, which should entail an increase in interest rates to central banks to combat inflation. But this is if the economy is growing and our economy is falling. So the Federal Reserve System is likely to refuse to comply with the instructions of the Trump administration to lower interest rates. If rates are lowered, of course, inflation will rise, especially if the tariff regime remains unchanged. Therefore, the US Federal Reserve is in a concrete impasse. After all, the economy is slowing down at the very moment when inflation expectations are rising, and this is a very alarming signal. Consumers in the US are also very worried. The Consumer Confidence Index has fallen to a record low. As for the latest employment data, this is the latest information about the labor market, which was published today by the data provider AD. The US economy added only 62,000 jobs in April, which is very little. This is the lowest figure since July 2024, and it is much lower than the 147,000 jobs that were added in March last month. And of course, this is another discrepancy between the fact and expectations. Leisure and hotel services showed the largest increase, adding 27,000 jobs. Other industries that also experienced growth include trade, transport, and utilities. About 21,000 jobs were added in these areas throughout the United States. 20,000 jobs have been added in the financial sector, in construction. 16,000 jobs. The Federal Reserve faces an extremely difficult choice: keep inflation under control or avoid rising unemployment. If it keeps interest rates high, it could further weaken GDP in the future and eventually lead to an increase in unemployment. On the other hand, if it cuts rates too early, there is a high probability that inflation will accelerate again, and, apparently, this is exactly what will happen in the future. All of this together puts the US Federal Reserve in an extremely difficult position, because it has to choose which economic risk is more important for it. By the way, pay attention to this graph. It is very interesting in the context of what can happen. We notice that the peak of unemployment falls at the moment when the US Federal Reserve lowered rates as much as possible. So it seems that this is exactly what will happen at some point in the future. Unemployment will peak at the moment when the US Federal Reserve has finished the cycle of rate cuts. Now let's talk about consumer confidence. This is a very indicative indicator that is really able to predict what may happen in the US economy in the near future. So, consumer confidence continues to decline. In April, consumer confidence in the United States fell sharply. This is a clear signal of increasing economic anxiety. The Consumer Confidence Index fell by 8 points to 86 points, reaching its lowest level since May 2022. In addition, this indicator has been falling for the fifth month in a row, which underscores the continued deterioration in consumer expectations. What is even more alarming is that the drop in confidence has been widespread, affecting all age groups and most income levels. Even more alarming is the Expectations Index, which reflects the consumer outlook for the next 6 months. It fell by 13 points to 54 points, and this is the lowest figure since October 2011. Yes, on the 11th. A reading below 80 usually signals a potential recession, and that is why this makes the current pessimism especially alarming. Because it is at around 54 points, which is well below 80. In general, Americans are now showing one of the darkest views on the economy in the last 10 years. JP Morgan now expects a recession within the next month, and, as you can see on your screen, the probability of a recession during the year has increased dramatically. Nevertheless, even after today's data release, the markets still give a 61% probability that the US Federal Reserve will cut the rate in June, and this year there will be at least 4 rate cuts. In other words, the market is mostly betting that the US Federal Reserve will choose the economy and not the fight against inflation. But the uncertainty of this forecast only increases as the US Federal Reserve faces both rising prices and a decline in employment. What will the Fed do? Let's see. This is an extremely difficult situation, especially given the recent disagreements between President Trump and Fed Chairman Jerome Powell. The behavior of the market also depends on their decision. If they lower rates, start quantitative easing to stimulate the economy, then we will repeat the coronavirus bull market. If they put their horns against the wall and even raise the rate on the contrary, then the pressure on the market will grow. However, this time Donald Trump and the new administration in the White House are also included in the game. And if the White House starts dictating monetary policy, then things could be even worse than they seem at first glance. Given all of the above, what is the most likely outcome? I would say stagflation. A combination of stagnation, economic slowdown, and price inflation. This is evidenced by today's data. And this is the worst possible scenario. All this is happening at a time when there is growing uncertainty related to tariff policy, a trade war, conflicts with many trading partners, a decrease in supply volumes, and disrupted supply chains. And this means that if the Trump administration does not change or cancel its trade measures, we may even see empty shelves in stores, a shortage of goods. And as demand remains relatively stable, prices may continue to rise if there is a shortage. This, by the way, was not my idea. Store managers warn about this, such as, for example, Walmart. Recently, it was the CEOs who started talking about this to President Trump. They expect a serious shock of the proposal, since the US raised tariffs on imports from China in early April. Shipping volumes have collapsed by as much as 64%, according to Bloomberg estimates. Due to a decrease in orders, sea carriers have canceled 25% of flights from China over the past 2 weeks. These vessels have already been redirected to other trade routes, so it will not be possible to just take everything back quickly. And this means that chaos cannot be eliminated instantly. Even if Trump decides to ease tariffs, things have already gone too far. In the best-case scenario, if Trump decides to reduce tariffs on China, cancelled orders can be resumed, which will lead to a sharp increase in demand. The maritime logistics network may simply not have enough capacity to handle this influx. The result will still be an increase in prices for sea transportation, possibly to the level of the 21st or 22nd years, when the cost of a container from China to the United States reached $20,000. So we are dealing with a completely unimaginable chaos, and this is just the beginning. Unfortunately, it will not be a quick thing to reverse everything, or you will have to wait for all this to settle down somehow.